Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle, as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and the short term is about confidence and sentiment. This month I'd like to cover some observations I have regarding the reality of what is happening within the U.S. economy. I'd like to cover the following subjects listed here. All equity indexes are currently above, at, or near all-time highs. What is of particular interest to us is that the S&P 500's information technology sector has broken all-time highs set back in March of 2000 at the peak of the dot-com bubble. The reason we watch it is to best correlate the major technology leaders, or what we have previously referred to in other reports as the generals, and we correlate those with central bank liquidity increases presently near approximately $300 billion per month. And you can see there's an extreme close correlation, and we're looking for it to break at some point, or in fact for the liquidity to start slowing dramatically. Unsustainable leverage from central bank liquidity injections is obviously lifting assets, but it's not lifting economic growth. The central banks have been very clear on their intent to begin QT, or quantitative tightening, and timelines are beginning to crystallize. Eventually, something will break, and as we will discuss in the following slides, below the surface, the signs of this are already beginning to emerge. The time to prepare is now, even though this may be many months away, or a few months away. The broader market, as represented by the likes of the Russell 2000, as I said, are showing signs of wanting to test support levels, although something is wrong, or maybe it's going to bounce and lift. The unquestionable user of the leverage mentioned a few slides ago are corporations in their use of buying back their shares. They have borrowed through debt and bond issues close to or over $1.5 trillion. This is unprecedented in market history, and the distortions it has created is a presentation unto itself. As you can see from this chart, this has been the driver of the U.S. equity prices almost solely by itself. However, as we have pointed out in previous presentations, this is beginning to change, as is the central bank policy direction. A very bad combination of shifts. The making of a perfect storm, possibly? It sounds like it, if it's true. This Q1 analysis from Goldman Sachs more clearly shows the exposure the markets have to a buyback slowdown already underway. Notice that the latest reduced announced buyback estimate, shown in red, leaves total net demand for U.S. equities perilously close to negative. And let's just say that the ETF number here starts to reduce or shifts dramatically into a negative position. I have pointed out on numerous occasions the lack of participation by the public and institutions in the market euphoria over the last few years. Even the leading traders have been witnessing a continued and unprecedented slowdown in trading volumes, which showed in all of the recent bank earnings. Though they were good, the revenues from trading are all continuing to fall. There just aren't the traders out there. Clearly, it's because of what is driving the market. I'd be amiss if I didn't point out one other critical flow in the current market euphoria, and I'm not talking about the fact that the central bankers have reversed their policy stand, which has been the whole basis for the market rise since QE1 and ZIRP were initiated. I'm talking about passive investing. I've talked about this also on a number of occasions, and I'll leave it to you to go back over previous reports where we discussed ETFs, or what I call potential weapons of mass financial destruction, when all the owners hit the sell button for whatever reason. Remember, in 2007, 2008, the financial crisis was initiated by chief financial officers effectively moving their money from money market funds into U.S. Treasuries, $5 trillion in one afternoon, which set panic and almost brought the global financial markets to its knees at the time, but it was the beginning of the precipice. Let's consider U.S. retail industry as an undertow of what is going on here. And this encompasses two of our strategic investment insights, or what I'll refer to as SIIs. That is retail stores, sales, and auto sales. This long-term view of retail and services sales show a steady year-over-year slowing in the rate of growth, which has accelerated since the post-financial crisis initial reaction to QE and ZIRP by consumers, and when it began to wear off, that is, after the artificial demand pull forward had occurred. The current level is problematic because it doesn't allow for the absorption of real inflation and pricing pressures. The shorter term view shows we are actually in contraction territory when we consider month-over-month sales having peaked in the fall of last year in 2016. Part of the problem is price discounting between brick and mortar competitors, and online offerings are driving prices even lower. If we continue towards a lower trend line, which we suspect is in the cards, then profits are in serious jeopardy and stock prices are headed lower for the retail sector, especially those chains with mall-centric business models. We strongly believe that U.S. retailers in total are now in a secular decline. This is for three reasons. Massive excess retail floor space having been brought to the market over the last 15 years, a financially depleted and squeezed U.S. middle-class consumer, and the rapid shift in acceptance of aggressive online retail offerings. As a result, retail bankruptcies are now an almost regular occurrence. Those retailers surviving are rampantly announcing store closings, with expectations currently for over 10,000 chain store locations to close operation in 2017. The department store model and its anchor store appeal for driving mall traffic is broken and in rapid decay. Meanwhile, Amazon continues to break down barriers to an increasing number of retail brand strongholds. In the area of auto, which we see to be cyclical in nature, the business cycle, the credit cycle, but cyclical versus the retail industry overall, as I said, which we see to be in a secular rotation, the auto sector may potentially forewarn of an even greater problem ahead for the downside of their cycle. The push to increase leasing, to make higher priced automobiles or light vehicles possible for purchasers, has left a looming off-lease inventory returns, which is a tidal wave that may potentially bring the industries to its knees once again, as occurred during the financial crisis, but for a different reason. Annual light vehicle sales, which was currently approaching 18 million units, is now expected to fall to 15.2 million units, and some are calling for it to be as low as 13.5 million, and they're saying they're being optimistic. This will be crushing, to say the least. Off-lease return vehicles are now expected to be 3 million this year in 2017 and 4 million in each of the next 3 years. With falling new vehicle sales and new cars not leased but having been bought on nearly 72-month financial terms, where will the new buyers come from to buy this glut? Repossessions, delinquencies, defaults are all rising from deep subprime to the higher credit levels. With anyone who could fog a mirror now in a new car, there is a monumental problem potentially at hand. Expect government payouts to soon appear on the horizon to incent buyers in some fashion. I discussed in another presentation my preferred discretionary spending gauges, but let me briefly highlight some points I made there. Vices normally lead overall retail sales. It is reflecting a very rapid decline and signaling we can expect overall retail sales to follow. Gambling continues to slow and is now actually contracting, as reflected by the average rates of gambling growth decline for Detroit, Maryland, Connecticut, Atlantic City, and Pennsylvania. While comps play a role in exaggerating some of the contraction, the trend is clear: less gambling. And that means less hot money floating around with households to play with. The last time this happened regarding restaurants, It was a pre-warning to the financial crisis. Usually, however, it is normally a sign of an approaching reversal in the business cycle and a potential coming recession. Economists like to look at sales of discretionary goods to determine whether or not the consumer is experiencing any potential weaknesses. Motorcycles tend to be a closely watched discretionary barometer. For the last 3 quarters, Harley-Davidson, symbol HOG, is reported by Bloomberg saying the industry is struggling amid soft used bike prices, economic uncertainty, and weakness in oil-dependent areas. This looks like a top, especially when you consider the attendance at the spring rallies at Americade in upstate New York and Laconia in New Hampshire. Attendance was way down once again. A relative who has attended these rallies for 20 years told me he was staying in hotels downtown when in prior years he had to find accommodations 20 to 30 miles away. He ventures to say that attendance is down at least minimally 25 to a third. He feels that it's primarily because the motorcycle crowd is older. They're baby boomers. Not only are they not buying new motorcycles, but they're selling the motorcycles. And on the other hand, motorcycles do not have the same appeal to the millennial generation. Whatever the reason, there are certainly a major slowdown. The U.S. macro data and the Atlanta Fed's nowcast predictions for U.S. GDP correlate well in showing the U.S. economy is stalled and rolling over. We normally have a recession every 5 to 7 years. We are now 8 years without one. 10 years is the longest we have witnessed in modern times. I personally do not believe the central bankers have the power to reverse the business cycle. This is pretty obvious where we are here. The global economy, on the other hand, is in even worse trouble in my mind overall, which is going to make matters in the U.S. worse and vice versa. The global credit impulse, which I watch very closely and have found to be very reliable, that is a second derivative of global credit growth, continues to rapidly fall. The credit cycle has changed. The business cycle is changing. I don't think there's any doubt, and I have shown this many, many times. Over time, every time this has occurred, as shown in this chart, that is a rising delinquency rate on credit card loans from all commercial banks crosses a descending commercial and industrial loans from the commercial banks. That is, lending standards are getting tighter, or the banks, for whatever reason, are being forced to tighten up. When they cross, we've never failed to have a recession, at least in modern times. This is about as good an accurate indication as we can get. Something is coming. It's showing up right across the board in retail, and it will spread from there. But remember, as the crisis hits and things get worse, they will print the money to solve any and all problems until such time as no one will take the money or it is of no value. That day is still in the future. So take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. And they're now locked in. There's pretty well no way out. The question is just how they will react with each of the new money printing helicopter drops that we can expect. It will force the market to levitate further for a little bit longer than we suspect. Your chances of success when this happens go up dramatically if you watch very, very closely. But at some point, it will snap. I'd like to take the moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 be an outstanding investment year for you and your family. Thank you very much for listening.